What can a Century 21 agent do for you? They explain the market, love a good barbie and never drink milk from the carton. They do your homework, your legwork and sometimes yard work. So invite one over. Century 21 agents. Smarter, bolder, faster.
Welcome back to Your Property Empire. Now, joining me on the show tonight is Lee Hatton, CEO of Eubank, and we've just been joined by Charles Tarbey, Chairman and owner of Century 21. Good to see you, Charles.
Thank you.
Now, we've had the two of these guys on for quite a while, so I thought we'd start off the year with a bit of a friendly debate on a couple of topics. Now, the first topic is, what are the pros and cons of fixed versus variable rates? And we'll start with you, Charles, with fixed. So what's the arguments for fixing your rate?
Oh, well, for me as an investor, I've always fixed rates because it just gets too complicated when you're paying down loans and when you're having to review your tax position at the end of the year. I don't like amortising debt. It's in real estate. I don't mind business, but when it comes to real estate, I just like the asset to grow beyond the debt rather than amortise the debt. But lately, a lot of banks are really pushing people to amortise debt on investment property.
So we're talking about fixing rates versus rather than doing P&I.
Yeah, well, that's it. Fixing is it, because I don't want to reduce debt. I would fix.
Right, okay.
That's what I meant. I wouldn't look at a variable loan. I'd look at a fixed loan because I just want to keep that loan as it is.
Okay.
And not
in
reduce
terms of advice to your kids, then you'd do that as well?
I actually did. I actually had them fix their loans probably about 3 years ago, and they might have a slightly different rate now, but they're ready to go again. So the timing's not too bad at all. So yes, I did get them fixed because there were just so many variables. Speaking about variable loans, there were so many variables at the time with the economy, and people were a bit unsure.
Okay. What are your thoughts, Lee? And we'll bring up a graphic as well with a few ideas you gave us before.
Yeah, so from a consumer perspective, I really think it just comes back to customer choice. So like you said, if your children or whoever you're advising wants some certainty, I'd absolutely look at fixed rates for them. But one of the wonderful things today is that we have choice, right? So you can absolutely choose. You want to have part of a fixed rate and part of a variable rate. I think one of the other things to just always, consider is to make sure where you're at in the cycle. And one of the pieces that you'll see through the data is that it could seem like we're pretty low in the cycle now, so it could actually be a good time to fix your rate.
Yeah, because the first bullet point you got on there is lowest since 1995, so it's certainly good.
Yeah, that's absolutely right. And also, too, you've got that flexibility of 3 versus 5. You've got some banks out there offering 10-year fixed rates. So I think it really comes down to your own risk appetite, what you want to do and what your goals are.
And my children's properties are investment properties, so that's why I would sit that way. What is your 5-year roughly now variable that you could find out there?
Yeah, we're 4.8
fixed,
or thereabouts.
Fixed.
Yeah, 4.8.
5 years.
Yeah.
It's hard to beat, isn't it?
But one of the things you got on there is the cost to break the loan. I remember in the GFC, a lot of people fixed because they thought the rates were going to go through the roof, and then they kind of plummeted.
Yeah.
And then suddenly the break costs for some people could be $50,000, $75,000, almost $100,000.
Yeah.
So that's a major disadvantage if you've suddenly got to sell or refinance, isn't it?
Yeah, and I think that's the piece. You need to take those factors into consideration when you're making those choices. And again, investor versus owner-occupier, the different choices that you'll make.
Look, if the rates are 4.8% fixed for 5 years, they're not going to come crashing down. So I reckon it's a pretty good bet to go for 5 years. But when they were 10s and 11s, yes, I get your point. But now that they're at that level, gosh, something really crazy has got to go on for them to get too much lower than that.
OK, and so just to play devil's advocate, who would be pushing the variable rate? So what are the advantages of going variable?
Well, a lot of people want to pay their homes off.
Yep.
It's a great Australian dream, and I guess that's really why they'll work it. They'll pay their interest ahead of time if they can, and set a process in place so that it reduces the term of the loan. A lot of people are now aware that you can reduce the term of your loan through various ways of repaying it. I mean, if you could pay your home loan daily, if it didn't cost you any fees, you're going to be so much better off than making the repayment at the end of the month. So I think for people who want to be owner-occupiers and that's it, that's what they want to do, that's probably the best advantage for them.
OK. Lee, and your thoughts? And we've got another graphic as well that we'll pull up.
Yeah, so I think absolutely from a variable perspective, it gives people such flexibility. And we really encourage people to pay down as much debt as they possibly can, as quickly as they can. So I think that absolutely lets them take some choice, like what are their own circumstances, what can they afford, what are their goals, and therefore how do they want to approach it. But again, these rates are looking really low, in terms of the a cycle, 20-year lows. So I think it's kind of really encouraging for people.
Yeah. See, I'm on the other side. I generally always go variable because what I found is when the APRA changes came in, say if you want to refinance, if suddenly one bank you're fixed with them, to try and refinance can be very, very hard. If suddenly APRA changes things, you need to move to another bank.
You've
that
got to
maybe
stop
has
changing
got...
banks so much, Chris.
No,
That's the issue.
I'm not a tard or anything like that. But,
I was going to
at
say there
times
was
you
a
need the money.
descriptor for you.
Yeah. Sometimes you need the money. And that just gave me the flexibility to do those kind of things.
Yeah, but what you do is a constantly moving process with your developments and so on.
Begging and borrowing,
so,
doing anything to get the banks the money.
So we're somebody who's looking to build a portfolio, and that's all they're going to do is just buy an investment property and sit. It's so much more secure for them. I mean, rents are starting to fall in some parts of Australia, so people really need to start looking at that too and factor that in as well. So,
and look, I think for most of the people, I always advise clients it's the sleep test. If you're really that worried about your mortgage and you work out what the costs are going to be if it's 1 or 2% higher, if you can't sleep, fix.
Yeah.
And fix for 3 or 5 years.
I reckon that's very good common sense advice.
Yeah.
Then sleep at least 1 hour a night.
Exactly. When it comes to fixing, say, 1, 3 or 5 years, for both of you, how would you go about trying to decide what's the best for you? Pete?
So again, absolutely back to personal circumstances, and again, there's no reason why you couldn't hedge your bets on all three, right? So if you've got some that you think you'll pay down in a certain period of time, you can take a 1 year. If you really want to take the attractive rates in the 5-year space, you'd take those too. But again, it all comes back to personal preference.
It's the same with yourself, Chris. Unless you're thinking of moving things around, 1 year fixed it comes around so quick.
Yeah.
So unless you're going to think of doing something at the end of the year, 1 year fixed is great. But generally 3 to 5 years. And I'd push for 5 years now because the rates are so attractive.
Yeah.
You know? Who knows what's going to happen at the moment with all of the economic noise out there.
Exactly. So we've got some different opinions, which is always good. Now, the second question I thought we'd do is bank versus brokers. So, Charles, you've got a broking arm of Century 21.
Yeah.
And obviously you're from UBank. We'll start
you
off
have a broking arm as well?
No, we don't,
Oh,
actually.
Oh, God.
No, and actually UBank doesn't deal with brokers, so I should say that right up front.
All right.
Yeah. So tell the viewers, why should they come to you or to any bank rather than go to the mortgage brokers?
So I think the key thing with going with your bank, again, personal choice, right? And what we've found over the years, because remembering I am a banker in totality, not just from a UBank perspective. And one of the big things when you're taking out a loan, one of the big decisions that's made is actually all against credit risk, right? And so what I find with the beautiful world of technology, a lot of simplicity now, by using the bank that you've always dealt with previously, you're really able to do things simply and easily yourself. Also, too, there's so much competition in the marketplace that you tend to find that you're getting really good deals straight up. You can do your own research if you want, but also, too, it puts you in control of the decisions you're making. And we were talking about this earlier, Charles. People will tend to remember their interest rates if they're more invested in the transaction. Yeah.
So generally, if you've been with the bank for, say, 5 or 10 years, they've got all your history, they've got all your pay slips, they can see all your money going in and out, you can generally make a reasonably quick decision.
Yeah,
Do you also have more, I guess, leniency to say, look, we've seen you go through your ups and downs, we know you're a solid customer, even though on the computer kind of credit scoring, you may not be perfect.
Yeah.
There's a bit of leniency there.
The whole computer says no thing? Yeah, no, absolutely.
The computer says no, but you can say yes.
Yeah,
That's that pommy humour you guys come up with all the time.
No, I think there's far more smarts in the system nowadays than there may have been, 5, 10 years ago. And I don't think credit is actually a mystery anymore. Mortgage lending, the rule of thumb, you can borrow 4 times your income. I don't think it's as complex as it ever used to be. And I'm actually really proud of the way the banking industry's tried to simplify it.
Yeah, so in the UK, I think we had TSB, the bank that likes to say yes, which for a marketing campaign, you're going to get caned in the media because they're going to say no at some point.
You do.
Charles?
Yeah, I agree on the relationship side. I think it's absolutely critical. The issue I do have with it is that people generally only buy and sell on a an irregular basis. If they're not doing it all the time, it could be 7, 10, 15 years. So the relationship they had with the person at the bank that they first met may not be there. So I tend to favour brokers because the brokers have got live relationships every minute of the day. They're working with the same banks every minute of the day on a variety of loans. So their relationship with the bank is going to be stronger than somebody who comes in off the street and hasn't been to the bank for 10 years to borrow again. That's the only issue. I think it's great if you can stick with one bank and you can get dealt with somebody you've done business with before, but it's fairly rare now because they move people around so much. So relationship with the brokers is a better way from my perspective.
But also, from the broker's perspective, do you find that certain banks specialise in certain types of customers? And so if you're self-employed, for instance, then you may not go with the Big Four, you might go somewhere else, whereas if you do fit into that...
You're always a bit too scared to go to the banks when you're in business because the process is so much more difficult. If you bank with that bank, they know your business intimately, far too intimately, and therefore the relationship can work against you. But look, at the end of the day, most of the brokers sell your loans anyway. It's just a matter of making sure that it meets what the client's looking for or is the easiest way to go to that client or for that client.
Yeah, and I would tend to agree that in the past it may have seemed more complicated to work with a bank, but I've certainly seen a change over the last kind of three to 5 years. Well, also too, they're realistic, right? Like it's common English to have a discussion around credit, whereas years ago it was a bit more complex and had a bit more mystique, I would say.
Now, I get the feeling you're going to rush me for the next slide.
We're going to jump into you, Charles. The show's all yours now.
I can see.
Let's see what statistics you've got
Tom?
For Tom's off on holiday or working or something like that today, unfortunately.
Okay.
But he's back next week.
Is he? Oh, great.
Right, the show's yours, Charles.
Yes,
Take it away with your clearance rate. I don't know if there is any clearance rate, is there?
Nothing, no clearance rates. There was a slight jump. I put the chart up before the end. I put the chart for the end of the year, so you can just see a little bit of a spike towards the end of the year when most people say it was slowing down. There's a bit of a spike in the auction clearance rates, and a lot of the agents are reporting good, solid open for inspections attendance across the country. So there is still a movement there, and it'll be interesting to see what it looks like after this weekend and what happened realistically last weekend. We'll consolidate those two and look towards next. Are we on next week?
Yep, we're on next week.
Oh.
So homes advertised for sale. So have we actually got any at the moment? Because
yes.
the market only really wakes up after Australia Day, isn't it?
It really dropped significantly prior to Christmas, as you'd expect it to, and then it jumped in the last week 3.48%. So there is a climb occurring now with stock coming on the market in some areas. Too much stock coming on the market. So a lot of agents in certain parts of Australasia are starting to get a little bit scared because they've got the stock and they don't have the buyers.
Have you got some ideas on kind of typical areas? So what kind of areas are getting too much stock?
Look, I'm really liking Perth, and I say this because a lot of the people are really getting pushed there at the moment. In terms of an investor, you're going in there. Some people are now starting to look at selling their properties below what their mortgage is.
So they're in negative equity.
There's been a really massive correction, so there's a lot of stock coming on. So I'm saying to the officers I'm talking to there, you really need to focus on the people who need to sell or want to sell. Anybody who's thinking about selling, you just really need to ask them to sit on the bench for a while.
So if we've got buyer investors out there, they should be trying to target those areas that have got massive stock to try and pick something up. Because you're not going to see you hear about Sydney moving back and a few of those areas, but that's not really moving back. There's just a modest correction from the quick jump that we had, or the spike at the end of the year. So I think those areas that are struggling are the areas you start looking at. And you think there's enough buyers in those locations? Because we have had viewers write in saying, look, I'm desperate, I've got to get rid of my property. There's still buyers around there.
That's the issue, actually. There's not enough buyers in some of those areas all of a sudden to meet the oversupply of stock that's coming on. So it's really quite a different story just so quickly in some areas.
OK, what about rent price movements? Yeah,
look, they have actually kicked off. I saw a report the other day saying Sydney's gone back. It hasn't yet in all of Sydney. Some parts may have. 1.71% increase this week over last week, and actually Brisbane had a 0.67% increase, which was great. But Darwin, which has always been going backwards, had a plus 1.8% this week over last week. So we've had a 0.4% increase for the start of the year. So actually up in the rentals. Are starting to climb up again.
And very quickly, the vacancy rates as well.
Sydney was not the best performer this time. Melbourne was. There you go. Melbourne came in at 2.89, Sydney at 3.37, and Perth, I'm still concerned about Perth. Vacancy rates are incredibly high, 7.66% for Perth, giving us an average across the three capital cities for vacancy rates of 4.64. So a bit scary in parts of Perth at the moment.
Wonderful. But general thoughts on the market for 2016?
Yeah, I think it'll be nice and steady, a good steady market. Once Perth settles down, we'll get that steady growth back again. Nothing great, but it'll be good.
Wonderful. Sounds good. Charles Tarbey from Century 21, Lee Hatton from Eubank. Thanks for joining us. Thanks for joining us at home for our first show for 2016. We'll have the whole team, including Tom Panos, with you next week. So until then, I'm Chris Gray. Good night.